The banking system is in the process of changing. And if you don't pay attention to these changes, you will be absolutely blindsided when the outcome is in your face. I'm about to expose the complete illusion of the Fed stress test. And guess what? 23 banks that participated, they all passed. I'm going to show you what they are not taking into account, because they are now allowing money to come out of, well, both the banks and the corporation. I mean, banks are corporations after all, which means that in this next upcoming crisis, they're going to be dependent on taxpayer bailouts. The ratio of liquid assets to deposits in the banking sector has declined 6 straight months. It's time people wake up and see what's happening. Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer really specializing in custom strategies, because we're all a little different, and then again, we're all the same. But you better have a strategy, because it should be very clear to you that the banks, the Federal Reserve, the government, they got a strategy. Now, we all know this saying. We've heard it many times, and it's true. You should never, ever let a good crisis go to waste. You should rather use that to consolidate your position, which is exactly what the banking sector has done over the years. This goes back to the beginning of this current trend. And these were the number of smaller banks in the system. Now you've got very few. And they're all consolidated just into the basic big 4 or 5. JP Morgan, Bank of America, who, was caught in fraud and double dipping on fees and stuff like that. But that's another video on another day. Wells Fargo, you know the names. So they're the ones, and we certainly saw that JP Morgan just absorbed SVB. So, this is the way that it goes until you have 1 or 2, or in this case 5, and you really have no choices. And what you really have is a basic monopoly or duopoly. And then your costs go up exponentially, because it is the bigger banks that gobble up the competition. And in fact, on a global basis, these systemically important banks, and any bank could have the ability to take this system down, but who's in the top 10? There's JP Morgan, there's Bank of America, there's Wells Fargo, and there's Morgan Stanley. But what you're also watching is the same kind of result of all of this gobbling up of the competition. The big just keep getting bigger. And if they were too big to fail before, you know darn well they're that much bigger if they fail. So bailouts, yeah, bail-ins for sure, and everything in between. But they won't do the bail-ins until they're ready to let the system go, because they don't really want you to realize that this is a probability. Not just a possibility, but a probability. And this whole system is a lot more systemic. Are you ready for this next big, ginormous crisis? Because on the surface, hey, they all passed the stress test, and look at this quarterly net income. Wow, it looks pretty good. In fact, strong growth in non-interest income, in other words, trading revenue, reflecting the accounting treatment of the acquisition of 2 failed institutions. They benefited from the failed institutions. Isn't that interesting? And record high trading revenues at large banks outpaced lower net interest income and higher non-interest expense. Higher non-interest expense. So their costs are going up, and the income that we think of, the interest income, which is the basic foundation of banks, that's going down. But their trading revenues and that leverage is also going up. And so they show quarterly net income. Industry net income would have been roughly flat quarter over quarter, and you can see it jumped right here, but it would have been flat quarter over quarter without the accounting impact of 2 failed bank acquisitions. So when there's an acquisition, the acquiring bank gets all the goodies and all the garbage stays in the FDIC system. So look at that. Quarterly net income went up, and on the surface, doesn't look too bad. The banking industry reported net income of $79.8 billion in the first quarter. Boy, they have like a lot of income to distribute, don't they? Up $11.5 billion or 16.9% from the prior quarter, thanks to those accounting gimmicks and the impact from those 2 failed banks acquisitions. So on the surface, this actually does look pretty good. I mean, this was 2020, but look at all the earnings and how well they've been doing through 2022 as the Fed and global central bankers have raised interest rates like crazy and actually impacted other things, which we're going to look at. But no worries, nothing to see here. All the banks passed the Fed's stress test. Perception management at its finest. All's fine in the banks. Keep your wealth in there. Keep your money in there. Listen to what they're telling you on Wall Street. Sure, they're doing all of this for your best interest, and I hope you realize I'm being completely facetious. But hey, big bank stocks advanced after the lenders aced that Fed stress test. Wow, look at that. See, banking crisis in March. Oh, that's yesterday. This is today. What are you worried about? Fed said lenders can start making payout announcements on Friday. Woohoo! They can start paying out to the shareholders, which is really what this is all about. It's not public benefit, it's shareholder benefit. So JP Morgan, Wells Fargo to pay higher dividends after stress tests. Morgan Stanley, Goldman, Citigroup also announced increases. But this is what you really need to know. Once they send that money out, it's gone. They go into crisis and they don't have enough liquidity. Well, just like we saw in 2008, there will be bailouts using taxpayer money after the bail ends. Now you could say to me, but Lynette, we just had all those banks fail and they didn't do any bail-ins. Well, they did with Credit Suisse because of the cocoa bonds. But in the US, they didn't bail in anybody's money. Why? Do you think that it's possible that they didn't do that because they didn't want to create more runs in an already extraordinarily fragile system? They're not ready for you to know the truth yet. So just understand, once that money leaves, it's gone. And look at what's happening. This is the quarterly change in deposits. This is from the FDIC's very recent first quarter review of the banks, the FDIC. So we've had 4 quarters of deposits leaving the banking system. Pretty substantially, actually. Deposits typically are the cheapest form of funding for the banks because they pay them the least amount. So, hey, that's great funding. But does it not put a hamper on the bank's ability to not just lend, but also trade if funds are leaving the bank? Yes, it does. And they've been fleeing the banks since the second quarter of 2022. That puts pressure on bank earnings, but the banks are making it up by taking more risk with your deposits. Because remember that they have these sweep accounts. You make a deposit, it's swept into a sub account that's in the bank name, and then they can use your equity as collateral for them to borrow and trade or lend out or do anything else that they want to do with it. Not only that, but the problem, one of the big problems, actually what you're looking at here, is the problem with what happened to all those banks back in March. Because it's also their unrealized losses on their investment securities. Now, the dark blue is held to maturity. So you can see not too much held to maturity here, almost nothing all over here. But look at all of these that are now being held to maturity. Why? Because they don't want you to see how bad it is. And if they set it up as held to maturity, then it's held at par because, as you guys know, okay, let's see, interest rates, principal value, market value of the bond, right? So as the Fed was lowering interest rates, boy, that made the principal or the market value of the bonds go up and made everything look good, even though it was making it more and more vulnerable and lulling everybody and forcing everybody out on the risk spectrum. But that changed quite rapidly in 2022 and 2023 as the Fed and global central bankers have been raising those rates. And look at this market value, right? It's in the toilet. And that's what you're seeing right there, okay? So, but if they hold it to maturity, then it looks like this. It's if they do it for sale, which is the gold available for sale securities, well, then they have to mark them to the market price, unless of course they're illiquid, and then they can say they're worth anything. But this is what's sitting on the bank books. And I don't care if you're JP Morgan or you're Wells Fargo or you're anyone else. This was not just relegated to SVB and the other banks that failed in March. This is on a global nature. And what does the Fed keep telling us? Well, that they are going to continue to raise rates to fight inflation because they are tied in. If they don't raise the rates to fight inflation, then inflation's going to pick up in a very big way and be obvious to the public. And that then tarnishes the public's confidence in the banking system. But if they do raise the rates, the banking system is more and more fragile and more vulnerable. And when you add that into everything going online, I don't even have to walk into the bank to pull my funds. That's what happened in March. You don't even have to do that. You can just push a button on your laptop or on your computer and you can move your funds out. So runs could easily become, and probably have, frankly, a much bigger problem. And you can see there was a run in the second quarter almost, right? And then they kind of had it under control. And then look what happened in the beginning of the first quarter 2023. That can get worse. That can get a whole lot worse. So can you see the stress just from these two charts in the banking system? But don't worry, because they all passed the stress test. Woohoo! This is awesome. Now, there is somebody that I do have a lot of admiration from, and that's Sheila Beer. And she was the former FDIC chair. And she is now in this breaking down what the Fed stress test tells us about the risks that big banks are facing and why she believes there is still work that needs to be done. And one of her issues, and interestingly enough, because this was brought up, but it doesn't really matter if they fix anything. Because the Fed's stress tests are not about making sure that the banks are really solid. It's about making sure that you think they are. It's all perception management. I've been saying that since 2009 when they came out with them. But here's a huge piece, because the banks are now being forced to pay more for deposits. Additionally, their cost of funding, whether it's from deposits or other sources, are already exceeding what they get on loans. And their interest expense has gone through the roof, especially was starting in 2022. No longer cheap funding. So the central banks, the Fed, and all the central banks got the banks used to all of this free money that just flowed and flowed and flowed. And now, because of the problem, the inflation problem that it created, they've got to go the other way. One way or another, there is a crisis that is very near in our future. And let us not forget the LIBOR SOFR. But banks spent more on interest expense in the first quarter, more than their average quarterly profit. Even though, well, let's go back and look at that for a second and think about these words that they just said. Here's their quarterly profit, and it looks good on the surface. But their expenses were more than that. So if you're spending more than you have coming in, you can get away with it for a little while if you have some level of savings that you can call upon, right? However, can you do that permanently? No. So all the banks pass the stress test. Now they are going ahead and they're sending that money out to the shareholders. And yet at the same time that they are doing all of that, they're getting weaker and weaker and weaker, and that money is gone. Right at the same time, they have to pay more for funding. Not only that, but non-bank sources of credit dry up in bad times. So where prior to 2008, the banks were the key funders for a lot of this debt and mortgages and all sorts of stuff, right? After 2008, that shifted and it went to non-bank sources for funding. Well, who are the new non-banks? Well, it'd be things like other corporations, but non-bank is anybody that kind of, or the shadow bank, they went into the shadow bank system. And a shadow bank is a bank that may perform some of the functions of a bank like lending, but they don't take in deposits. And they are not under the, not that that helped very much with SVB, but they're not under the regulation of the central banks. And they are, however, dependent upon the commercial banks for their funding, though they could also be dependent upon investors. So in bad times, all of that credit dries up. You think we're going into bad times? Mm-hmm. So they're saying that they need more transparency, or Sheila is saying that we need more transparency into bank and non-bank sector relationships, because the reality is that the whole entire system, whether you're a bank, a corporation, a shadow bank, a non-financial institution, they're all incestuously intertwined. And with the non-banks and the shadow banks, that's even less visibility than in the banking sector. Keep this in mind. Not only that, but there are problems with the scenarios that underpin the stress tests. And that's because these stress tests are really, really, really not about making sure that the banks are safe. It's about you believing that the banks are safe. And of course, we know since what happened in March that there have been a lot of discussions on moving that guarantee. Let's see, when was that FDIC guarantee put in place? Oh yeah, 1933, when they were trying to get the public back into the banking sector. right? So the FDIC, as we know, and I'm going to show you again in a few minutes, they don't have the money to pay you out. They don't have it. So what happened in March was the FDIC went to the Federal Reserve, who went to the Treasury and borrowed the money to pay and cover up all of these bank failures. And even that, quite honestly, that was just a cover up so that you didn't realize everything that I'm showing you today. Because once you are really clear that the banks are not safe, that Wall Street is not there for your benefit, but rather all of this is about lulling you into a false sense of security so that you hold your wealth in the system and it's easier to take from you. And by the way, who are you going to complain to? The bank bails your money in. I mean, we've seen it all over the place. You can go bang on those doors all you want. Doesn't matter. We're too far removed anymore. I mean, in my youth, we were not removed. You could talk to the bank president that could actually make a decision. You could get to the decision makers. Today, let's face it, can we get to the decision makers? Not typically. It's rare, and certainly not at JP Morgan or Goldman's. You're not going to talk to Jamie Dimon. He's not going to take your call, I guarantee. And at the same time all of this is going on, big U.S. banks to post largest rise in loan losses since the pandemic, and frankly, this is just the beginning. Analysts predict the combined cost of loan charge-off losses marked as unrecoverable. They ain't getting that money back. And new provisions was $3.8 billion in the second 3 months of the year. That would be up, count it, 120% from the $1.8 billion in soured loan costs reported on the nation's largest bank year over year, same quarter, year over year. So as this free money dries up, there are more problems that are coming up. And we're talking about the non-banks, the shadow banks, the corporations. This is just the beginning. Just the beginning. Now let's look at the FDIC. Okay, this is the current report that they just did. Ratio of liquid assets to deposit. Well, what does that even mean, right? What this is a measure of a bank's ability to meet an outflow of deposits. This ratio increased significantly during the pandemic, as I don't know if I have any more in here, but I have another one. See, that's it. You use one, you get another one. Just ask the Fed. This ratio increased significantly during the pandemic as bank deposits and liquid assets swelled, but has since declined for 6 straight quarters. So that means that if there is a run on the bank, can this bank survive it? Can you get your money out of it? Well, what's the problem? After all, we just saw what happened in March and everybody was guaranteed 100%, even if you were above the limit. Isn't that great? Well, let's see the impact to the FDIC and the speed at which this could shift. I mean, I got to tell you, this is why we provide you with free strategy consultations, so you can prepare for what's coming and getting into position. Because you absolutely, without any doubt, need to be in a position. Can you see what I'm trying to show you here? So this is the diff reserve ratio and balance. This is the money that the FDIC set aside to pay you out if your banks failed. And look at what happened going into 2008 from 2007. Can you see how quickly that declined? And then, because of all of the free money, that increased. But this is a pretty sharp decline. Is this going to keep going down? Well, it depends on how many more banks are going to fail. but it definitely shows the vulnerability because the FDIC did not have enough to pay out all those bank failures in March, and those were small community banks or smaller community banks. Has that gotten better? And they say, whoa, we didn't use taxpayer money. We didn't use taxpayer money. Well, who do you think actually pays for these costs anyway? Because what they do, and what they say that they do, is they charge the banks that are existing more to replenish this fund. That's how all of this got built back up. But if they're doing that into an environment that looks like this, can you see the problem? Can you see the stress? But don't worry, every single bank passed the stress test. Woohoo! They can now just pay out those dividends, send that money out of the bank, and you know, what happens to you? What can I tell you, right? Because what we're really looking at here, can we go? Thank you. 2019 is when the peak of the reserve ratio happened. And it's been declining since 2019. And what else happened in 2019? Oh yeah, the money market plumbing, the repo market froze. And guess what? Powell recently said that he did not, that the runoff of their balance sheet, which led to the freezing of the money market plumbing, the global money market plumbing, and then all the printing that they did thereafter to save that, and the new creative accounting tricks that they use to make things look like they're okay and keep it hidden from you. He said he didn't do it very well. No, Sherlock, you can fill in that blank. I mean, you can't make this stuff up. So the ability to survive a run is declining, and the ability to pay out depositors is declining, and it's doing into an arena of rising costs and declining valuations of the assets that they're holding. That, my friends, is a recipe for disaster. And what do we have next? Oh, well, this is July. Toward the end of this month, the Fed Now instant payment regime begins. So interestingly enough, they have put in place, we all have those accounts, whether you realize that you have it or you don't realize that you have it. But now, well, let's see, we're in July. Guess what begins? The Fed Now regime begins. Now, what is the Fed Now? We've talked about it many times, but simply put, you now, whether you realize it or don't, and I don't care where you live in the U.S., it can be in a rural, or you can be in the city center, we all have accounts directly with the Federal Reserve. Now, it's inside of all of the banks, and if you're in a rural area and you bank at the post office, it's in there, and it's in every credit union and every community bank. So is this going to help the current banking system, or could it hurt it? Because if you have more confidence in having an account directly with the Federal Reserve, and this next crisis, where are they going to put the money? To stimulate the economy, they're going to put it in there. They're going to sucker you in to using what they've created for you until they can control you directly. This is why you got to do this. This is why you've got to have wealth outside of the system too. Because the whole entire financial system, it's like sand underneath your feet. But you don't feel that sand just yet. And let me tell you, it's quicksand when you do. SVB clients get a painful lesson. And what is that lesson? Bank failures are common. If they can keep it limited to a few here and a few there, then they can figure out how to accommodate that. That's why it was so incredibly important that they get you lulled back into feeling like your bank is safe and to stop those runs. They did in 2022. There was a whole litany of central bank presidents that came out saying, we'll just print the money. You don't have to worry about pulling money out. You can just print it. A lot of new printing happened then. But such a long time without news of a bank collapse seems to have lulled depositors into a false sense of security. But let's see what that looks like. Because here we had all of this time from 2000 to 2008 as the Fed and as our government was building a lot of debt, changing rules, getting this next crisis built, and here it is. I mean, I wish this went back to the savings and loan as well. But it wasn't until 2010 that we hit peak bank failures. And as you saw, let me go back to that so you can see it again. The diff was out of money in actually a really big way. And they said that if even one more small bank failed, they would not be able to keep this hidden from you. This is 2010. I want you to seriously keep that in mind, because the reality is there have been 565 bank failures in the U.S. just since the turn of the millennium. But there have been over 4,800 currencies that, I mean, they just do not exist anymore. Because if a government can say this is money, they can also say this is not money anymore. Lots and lots of 4,800 of them. And we're about to have, well, there's 196 countries in the world. And if all those countries fail, you can add that on to the 4,800 plus. Oops. Well, you see, so they get a little hit, and that didn't take it down. We'll see when they will indeed take it down. Because do you think that the free money and all of the changes in the accounting and all of that could have hidden a lot of the problems in the banking system? And guess what? Maybe they're hiding it now too. What do you think? And do you think that this could actually sow the seeds of the next crisis? Is that a possibility? Because bank failures are very common in a shifting financial system. And I said it in 2008 and all the time since. This is when the system died. It died, and it went on the free money printing, spectrum to make it look like it was okay. It's not okay, because the system died. Now they need a big, huge they needed that time to build the next system. Maybe that's the CBDCs. Maybe they're ready. Maybe they're not ready. But I wanted to share this with you, and I'm doing a whole piece on it, but it's taking me a while to go through. I'm just going to read you this letter from one of the ITM clients that I really appreciate shared this with us. And this is from Webster Bank. So this happens to be in Connecticut. But we are pleased to share that on July 24th, 2023, we will introduce a new operating system and digital platform that will help us bring you important enhancements, including a new lineup of products and services. This transition will take place over the weekend of July 22nd and 23rd. Always happens over the weekend because you can't really do anything about it. Except maybe in this new digital world, maybe weekends don't matter as much. So in this package, you will find important information on what will help guide you through this transition. And what they're also saying in here, we are committed to making this transition as easy as possible for you, because what they're doing is they're changing all of your accounts. So all your old accounts are going away, and they're all going to be replaced by new accounts, and they're going to do everything they can to keep it looking as normal as possible so that you don't make different choices. Now, here is what they sent him to make sure that he reads this booklet very carefully so that he can tell what the changes are. I've already started going through it and highlighting it, but I haven't been able to figure out from their outline of this letter what indicating exactly what those changes are. So this could have something to do with the FedNow account. It could absolutely 100% have something to do with the LIBOR to SOFR shift. I'm going to find out, and I'm going to tell you, because I'm 100% certain this is happening all over, whether you realize it or not, because getting these things in the mail is pretty normal. Getting them online, do you really pay attention to this stuff? No. And look at how small is that print? And this booklet is 64 pages long. So the next step is for you to make sure your wealth is protected and your strategy is sound, because there's no need to fear what's coming if you do have the proper plan in place. There's a link below to schedule that free strategy call at a time that works for you. And if you're in a rush, 888-696-4653. So you can get this done ASAP, which is frankly what I recommend. Because the reality is financial shields, they're made of metal, not paper. And this whole house of cards and this whole domino, once one goes, they're all going. So if you haven't already, make sure you subscribe. Leave us a comment, give us a thumbs up, but most important, share, and get your strategy, not just in place, but actually executed. And until next we meet, please be safe out there. Bye-bye.